Hi everyone, my name is Chengwei Wang, and thank you for being here. Today I will be presenting a compre- comprehensive performance review of our AI theme investment portfolio for the period spanning from January 2017 to December 2022. Over the next 15 to 20 minutes, we will walk through three key areas. First, an introduction to the portfolio's core investment thesis and the macroeconomic landscape it operated in. Second, a deep dive into the quantitative result using our interactive performance dashboard. And finally, a conclusion and recommendation based on the through evolutions of whether the fund achieved its objectives. Let's begin. The foundational goal of this portfolio was to capture the long-term transformative growth of the artificial intelligence revolution. Our core thesis is that AI is a foundational technology, much like the internet, that will drive innovation across nearly every industry for decades. Our strategy was to enter the portfolio with a significant holding in a key enabler, NVIDIA, and complement it with a diversified basket of companies integral to the AI ecosystem, such as those in data centers, automations, and autonomous technology. As you know, these 6 years period was incredibly turbulent. We navigated three distinct economic phases. The first one, the stable bull run from 2017 to 2019. The unprecedented pandemic boom of 2020 and 2021, which massively accelerated digitalization, and finally, the inflationary shock of 2022, which saw aggressive interest rate hikes and a significant market downturn. Despite this volatility, our thematic focus proved to be a powerful driver of performance. Let's dive into the data to see exactly how we performed. Here we have our interactive dashboard, which consolidates all of our quantitative analysis. We'll start with the overall portfolio view. The first chart I want to draw your attention to is the cumulative growth of a $1 investment. This is perhaps the most telling visual of our performance. The solid dark blue line represents our AI-themed portfolio. The two dashed lines are our benchmarks, the S&P 500 and Nasdaq in light gray. As you can clearly see, our portfolio significantly outperformed both benchmarks over the 6-year period. An initial investment of $1 at the beginning of 2017 would have grown to $2.38 by the end of 2022. This demonstrates substantial wealth generation that far outpaced simple market exposures. Also in this graph, you can choose to comparison different companies with our AI theme portfolios and S&P 500. Just click on it and it will show up. So this is a really good chart to comparison our our portfolio with um, from different companies with our benchmarks. Now, let's quantify this outperformance. Here, we see our key performance and risk metrics compared it to S&P 500. First, our alpha is 18.52%. This means that after accounting for market risk, our strategy generates an exit return of over 18% per year. This is a direct measure of the value added by our thematic stock selection. Second, our beta is 0.19, which indicates our portfolio is significantly less volatile than the S&P 500. This is a remarkable result, suggesting strong defensive characteristic despite our concentration in technology. Crucially, our Sharpe ratio is 0.76. This is a strong figure that tells us we were handsomely compensated for the additional risks we took on, delivering superior risk-adjusted return. From a risk perspective, our 95% monthly value at risk was minus 11.57%. This means we can be 95% confident that in any given month, our losses would not exceed this amount. The conditional VAR shows that in the worst 5% of cases, the average loss was around minus 13%. The next model provides a more academic validation of our strategy using the capital assessed pricing model. The Jensen's alpha here is 19.47% annualized. This confirms the alpha we saw earlier and provides robust statistics evidence that our portfolio's outperformance was not just due to the market movement, but due to the skill in stock selection. The R-squared value of 0.19 tells us that about 19% of our portfolio's returns can be explained by the market movement. This is a healthy number showing a strong correlation to the market, but leaving significant room for alpha generation. And ours. And finally, let's look at the performance attribution. The top three performance are Tesla, Nvidia, and MA. These were the runaway leaders, validating our high conviction bets on distributed technology. Tesla capitalizes on the EV revolution and the advancement in autonomy, while Nvidia cemented its role as the essential hardware provider for the entire AI industry, causing demand for their chips to explode. And the bottom three performance, like SLB, was subject to the cyclical nature of the energy market, which acted as a drag during central periods. Defensive holdings like the UK performed as expected for a low beta utility, providing stability but naturally lagging the explosive growth of the tech components. It highlights that the intended diversification within the portfolio. The market condition analysis shows that in months where the S&P 500 was positive, our portfolio delivered an average return of 10.41% in months when the market was down. Our portfolio's average loss was 0.99%. This demonstrated a powerful ability to capture upside while managing downside risk effectively. To see how this works at individual level, let's quickly drill down into our top performance, Tesla. The view now updates to show only Tesla's data. We can see it's incredibly grows right here. Interestingly, it has a very low beta of 0.5, which suggests its returns are driven far more by company-specific news and fundamentals than by the overall market movements. We can also review its yearly performance here, and I want to specifically point out the explosive growth in 2020. This was a pivotal years for the company, driven by several key factors. Its inclusion in the S&P 500 index, a successful stock split that made shares more accessible, and a massive ramp up in production and vehicle deliveries, and that provides its ability to scale, fueling incredible investor enthusiasm. This dashboard provides a transparent and comprehensive look at all aspects of our performances. You can just click the different company. You can see all the data down here. And now let's move on to the last part, conclusion. So how does all this data tell us? Let's bring it all together. Our first question was, did the fund achieve its objectives? As a reminder, we set an expected annual return of plus 8% for the 2017 to 2019 period and plus 10% for the 2020 to 2022 period. The results speak for themselves. In the first period, we delivered an actual annualized return of 24.1%. And in the second period, even with the 2022 downturn, we still delivered plus 20.5%. The fund has unequivocally and sustainability exceeds its performance objectives across all phases. This brings us to the final and most important question. Should we continue investing? Based on this comprehensive review, our recommendation is a firm yes. To continue operating the investment fund, its recommendation is built on four key pillars. First, proven alpha generation. With Jensen's alpha of over 14%, we have statistically proven that this strategy is not just riding the market, but actively generating excess return through superior stock selection. Second, the enduring AI secular trend. Despite any short-term economy headwinds, the AI evolution is still in its early innings. The long-term trend of AI integration across all sectors remains one of the most powerful tailwinds in the global economy. Third, superior risk-adjusted return, the Sharpe ratio of 0.77 confirms that our performance isn't just a result of taking on excessive risks. It is a result of efficient and skillful investing. And finally, resilience. Our analysis shows the portfolio performance exceptionally well in bull markets and manages risks effectively in bear markets. In conclusion, the found strategy has been validated. Its core thesis remains more relevant in than its core thesis remains more relevant than ever, and it is perfectly positioned to capture the next wave of growth in the AI revolution. Thank you. I'm now happy to answer any question you may have. And if there is no question, there will be my report today. Thank you for your attention.